episode 4 of the IFRS 15 Made Easy series. So far, we have learned how to identify a contract with a customer and its performance obligations within the new IFRS 15 Revenue Recognition Standard. We are from Kong Lim and Partners, Chartered Accountants of Singapore and a member of JHI and Task. And in this video, we will be going through step 3 of the revenue recognition model, determining the transaction price. First, let's define what is a transaction price. A transaction price is the amount of consideration to which an entity expects to be entitled in exchange for transferring the promised goods or services to the customer. However, this excludes the amounts that you may have collected on behalf of third parties, for example, sales tax. The new IFRS 15 standard states that in determining the transaction price, accountants should include variable consideration, the existence of a significant financing component, non-cash consideration, and the consideration payable to the customer. If the consideration promised in a contract includes a variable amount, an entity shall estimate the amount of consideration to which the entity will be entitled in exchange for transferring the promised goods or services. Examples of variable consideration include discounts, rebates, refunds, credits, price concessions, incentives, performance bonuses, and penalties. Therefore, in this new standard, the transaction price may include both fixed and variable amounts, as well as other considerations. There may be times when your transaction price could be a range of possibilities depending on outcomes or effects of the contract. IFRS 15 states that an entity shall estimate an amount of variable consideration by, number 1, establishing the expected value, which is the sum of probability-weighted amounts in a range of possible amounts, or, number 2, establishing the most likely amount, which is the single most likely amount in a range of possibilities, usually when there are two possible consideration amounts. Lastly, variable consideration should not be included in the transaction price if these factors that increase the likelihood of revenue reversal are present. Let us look at an example of variable consideration. Entity A entered into a contract with customer B. In terms of the contract, Entity A will build a shopping complex for customer B. The contract price was agreed between the two parties at $1 million. A performance bonus of $500,000 is payable should construction be completed by the agreed date. The bonus will decrease by 10% per week for every week past the agreed date. As an accountant, you will have to determine which is the most likely date of completion by Entity A. With past experiences of similar contracts, you may estimate that there is a 60% probability that the contract will be completed by the agreed date, a 30% probability that it will be 1 week late, and a 10% probability that it will be 2 weeks late. Calculate the estimated variable consideration to be received by Entity A based on a probability-weighted method and the most likely outcome. Using the probability-weighted method, the total estimated revenue would be $1,475,000. In the case of the most likely outcome, the estimated revenue would be $1.5 million. Since there are more than two possible outcomes, the probability-weighted method should seem more appropriate. When determining the transaction price, one should consider whether the promised amount of consideration provides the entity or the customer with a significant benefit of financing the transfer of goods or services to the customer. For example, if a contract states that the goods are to be delivered today, but the customer is only required to make payment in 2 years, that creates a significant financing component to the agreement. The significant financing component may exist regardless of whether the promise of financing is explicitly or implicitly stated in the contract. An entity shall assess whether a contract contains a financing component and whether that financing component is significant to the contract by determining both of the following. A. The difference, if any, between the amount of promised consideration and the cash selling price of the promised goods or services, and B. The combined effect of both of the following. Firstly, the expected length of time between when the entity transfers the promised goods or services to the customer and when the customer pays for those goods or services, and number 2, the prevailing interest rates in the relevant market. However, IFRS 15 states that no adjustment is required if the time between the transfer and payment is 1 year or less. Let's look at an example. On the 1st of August 2013, Entity A enters into a contract with customer B. In terms of the contract, Entity A would deliver a product to customer B on 1st August 2013. The full contract price of about $1.4 million is payable by customer B on 31st of July 2017, 4 years later. The regular cash selling price of the product is $900,000. The costs incurred by Entity A to manufacture the product amounts to $590,000. Entity A makes use of the perpetual inventory system. Prepare the general journal entries to account for this economic event in the accounting records of Entity A for the year ending on 31st December 2013 in accordance with IFRS. The general journal entry for Entity A would look like this, where the interest rate of 12% is derived from the difference between the full contract price of $1.4 million and the regular cash selling price of the product at $900,000. The effective interest rate method was used. To determine the transaction price for contracts in which a customer promises consideration in a form other than cash, an entity shall measure the non-cash consideration at fair value. If an entity cannot reasonably estimate the fair value of the non-cash consideration, the entity shall measure the consideration indirectly by reference to the standalone selling price of the goods or services promised to the customer in exchange for the consideration. If a customer contributes goods or services, for example, materials, equipment, or labor, to facilitate an entity's fulfillment of the contract, the entity shall assess whether it obtains control of those contributed goods or services. If so, the entity shall account for the contributed goods or services as non-cash consideration received from the customer. Let's look at an example. An entity enters into a contract with the customer to provide a weekly service for 1 year. The contract is signed on 1st of January 2013 and work begins immediately. The entity concludes that the service is a single performance obligation. This is because the entity is providing a series of distinct services that are substantially the same and have the same pattern of transfer. In exchange for the service, the customer promises 100 shares of its common stock per week of service. The terms in the contract require that the shares must be paid upon successful completion of each week of service. To determine the transaction price and the amount of revenue to be recognized, the entity measures the fair value of 100 shares that are received upon completion of each weekly service. Consideration payable to a customer includes cash amounts that an entity pays or expects to pay to the customer. This includes credits, coupons, or vouchers. An entity shall account for consideration payable as a reduction of the transaction price and therefore of revenue unless the payment to the customer is in exchange for a distinct goods or service. If consideration payable to a customer is a payment for a distinct goods or service, then an entity shall account for that purchase in the same way that it accounts for other purchases from suppliers. If the amount of consideration payable to the customer exceeds the fair value of the distinct good or service, the entity shall account for the excess as a reduction of the transaction price. If consideration payable to a customer is accounted for as a reduction to the transaction price, an entity shall recognize the reduction of revenue when, number 1, the entity recognizes revenue for the transfer of the related goods or services to the customer, and, number 2, the entity pays or promises to pay the consideration. Let's look at an example. An entity that manufactures consumer goods enters into a 1-year contract to sell goods to a customer. The customer commits to buy at least $15 million of products during the year. The contract also requires the entity to make a non-refundable payment of $1.5 million to the customer at the inception of the contract. The $1.5 million payment will compensate the customer for the changes it needs to make to its shelving to accommodate the entity's products. The entity concludes that the payment to the customer is not in exchange for a distinct goods or service that transfers to the entity. Consequently, the entity concludes that the consideration payable is accounted for as a reduction in the transaction price when the entity recognizes revenue for the transfer of goods. As the entity transfers goods to the customer, the entity reduces the transaction price for each good by 10%. Therefore, in the first month in which the entity transfers goods to the customer, the entity recognizes revenue of $1.8 million. For more in-depth examples, stay tuned for future episodes of our series.